Remember the late 90s? The sound of a dial-up modem, the thrill of getting your first email address, and the feeling that the internet was about to change everything. Well, it did. But not before taking investors on one of the wildest rollercoaster rides in financial history, the dot-com bubble. This is the story of how a revolutionary technology sparked a speculative frenzy, created billionaires overnight, and then came crashing down, leaving a trail of bankrupt companies and shattered dreams. But it's also a story of resilience, innovation, and how the ashes of that crash gave rise to the tech world we know today. So, where did it all begin? The mid-1990s. The internet was moving from military and academic circles into our homes. The launch of the first user-friendly web browser, Netscape Navigator, in 1994, was a game-changer. Suddenly, anyone could access the World Wide Web. This unleashed a wave of excitement and optimism. Investors saw the internet as a new frontier, a digital gold rush, and they were desperate to stake their claim. The logic was simple, or so it seemed. Any company with a .com at the end of its name was seen as a guaranteed ticket to riches. It didn't matter if the company had a clear business model, a path to profitability, or even a finished product. All that mattered was eyeballs, the number of visitors a website could attract. The belief was that once you had the audience, you could figure out how to make money later. Venture capitalists and everyday investors poured billions of dollars into these new internet startups. The IPO market went into overdrive. An initial public offering, or IPO, is when a private company first sells shares to the public. During the dot-com boom, companies would go public and their stock prices would double, triple, or even quadruple on the very first day of trading. Take a company like The Globe.com, an early social networking site. It went public in 1998, and its stock soared over 600% on its first day. Everyone, from seasoned Wall Street traders to taxi drivers and dentists, was getting in on the action, buying stocks based on hype rather than fundamentals. It was a classic case of what economists call irrational exuberance. Companies spent lavishly. They threw extravagant launch parties, ran expensive Super Bowl ads, and offered insane perks to attract talent. Pets.com is a famous example. They had a catchy sock puppet mascot and spent a fortune on advertising, but their business model, shipping heavy bags of pet food at a loss, was fundamentally flawed. Another one, Webvan, promised to deliver groceries to your door within a 30-minute window. They invested billions in state-of-the-art warehouses and a fleet of delivery trucks. It was a brilliant idea, but it was way ahead of its time and logistically unsustainable. These companies were burning through cash at an alarming rate with no profits in sight. The market was being propped up by pure speculation. People weren't buying stocks because they believed in the long-term value of the company. They were buying them because they thought they could sell them to someone else for a higher price tomorrow. This is the definition of a speculative bubble. The first cracks started to appear in late 1999 and early 2000. Interest rates were rising, making it more expensive for these cash-burning companies to borrow money. Big institutional investors began quietly selling off their dot-com stocks, sensing that the party was about to end. On March 10, 2000, the tech-heavy Nasdaq Composite Index peaked at over 5,000 points. Then, the slide began. It wasn't a single catastrophic event, but a slow, painful bleed. A few major dot-coms reported disappointing earnings. Japan entered a recession. Microsoft faced a major antitrust lawsuit. Each piece of bad news chipped away at investor confidence. The sell orders started to outnumber the buy orders. Panic set in. The same people who had been desperately buying stocks were now desperately trying to sell them, but there were no buyers. The crash was brutal. Between 2000 and 2002, the Nasdaq lost nearly 80% of its value. Trillions of dollars in market value evaporated. Companies that had been worth billions were suddenly worthless. Pets.com, Webvan, eToys, they all went bankrupt, becoming poster children for the era's excess. Thousands of people lost their jobs, and many small investors saw their life savings wiped out. The dream was over. Silicon Valley, once the epicenter of optimism, became a ghost town of empty office buildings and for-lease signs. It would be easy to dismiss the dot-com bubble as a period of collective madness, a complete failure. But that's not the whole story. While the speculative frenzy was destructive, the underlying technological revolution was real. The bubble may have burst, but the internet wasn't going away. In fact, the crash served a crucial purpose. It was a painful but necessary correction that cleared out the weak, unsustainable business models. It forced the companies that survived to focus on what actually matters: profitability, efficiency, and creating real value for customers. Think about the companies that emerged from the wreckage. Amazon, which was famously criticized during the boom for not making a profit, survived by building a robust logistics network and relentlessly focusing on the customer experience. eBay survived because it had a simple, effective business model that was profitable from the start. And look at the giants that were born in the aftermath. Google, founded in 1998, went public in 2004, long after the dust had settled. They had a superior search technology and, crucially, a revolutionary advertising model, AdWords, that turned search queries into billions of dollars in revenue. They learned from the mistakes of the dot-com era. The infrastructure built during the boom, all that fiber optic cable laid, all those data centers constructed, didn't disappear. It became the foundation for the next wave of innovation. Without it, we wouldn't have the high-speed connections necessary for streaming services like YouTube and Netflix, or the cloud computing that powers social media like Facebook and Instagram. The dream of Webvan, delivering groceries to your door, was eventually realized by companies like Instacart, but only after smartphone technology and logistics had matured. So, what are the lasting lessons of the dot-com bubble? First, it's a powerful reminder that hype is not a business strategy. Eyeballs don't pay the bills. A solid business model and a path to profitability are essential. Second, it highlights the dangers of herd mentality in investing. Just because everyone is doing something doesn't mean it's a good idea. Doing your own research and understanding the fundamental value of what you're buying is critical. But perhaps the most important lesson is about the nature of technological revolutions. They are often messy, marked by periods of wild speculation followed by painful corrections. The dot-com bubble wasn't the first, and it won't be the last. We've seen similar cycles with everything from railways to radio, and more recently, with crypto and AI. But through it all, true innovation endures. The dot-com bubble was a spectacular failure, but it was also a spectacular success. It was the chaotic, fiery birth of the modern digital economy. It cleared the way for a stronger, more resilient tech industry and laid the groundwork for the world we live in today. It's a story of greed and genius, of failure and rebirth, and a timeless lesson in the exhilarating, and sometimes terrifying, power of a world-changing idea. Thanks for watching. If you found this look back at tech history interesting, don't forget to like this video, subscribe to the channel, and hit that notification bell so you don't miss our next deep dive. See you next time.